real estate, stocks, a business, saving money. They don't create generational wealth day one. Infinite banking is the opposite. It does create generational wealth day one. Because it is life insurance, it has a death benefit. Now that death benefit is tax-free and is guaranteed. This is how wealthy families secure their wealth, knowing that it's guaranteed tax-free to be passed on at some point down the road. We always say, I wish I had learned about this 20 years ago. Well, guess what? Start it on your kids, because they won't have to say the same thing. Well, hello everybody, Brian Fouch here in place of Chris Naugle. So on Wealth Wednesday webinars, we talk about different concepts when it comes to building wealth, things around wealth. And today what we're going to be talking about is generational or legacy wealth. And that's one of those things that I don't think is talked about enough. Now, if you've been around our campfire quite a bit, one of the topics that we do talk about quite a bit is the infinite banking concept. And that's going to play a part in our discussion here today. So I got a question for everybody here on the call today. So when it comes to when you hear the term generational wealth or legacy wealth, what does that mean to you? What do you think of when you hear that term? So use that chat box right there. Let me know what you think about when you hear generational wealth, legacy wealth, that kind of stuff. What's it mean to you? Big family money, okay. What else? So generational legacy wealth, what's that mean to you? Money for your kids, I like that one. Yeah, Frenchie, yeah, passed down. Yeah, money that or wealth that is passed down. Legacy is what you leave behind. I like that one. Yeah, for sure. For me, it is how I educate since I don't have children. Absolutely love that one. It's knowing that my children and children's children will not have to struggle financially. I love that one, Lucy. That's a great one as well. I give inheritance to my family. Absolutely. Passing on, right? Yeah, absolutely. Passing on is kind of what I look at. So what I can give to my family, leaving an inheritance for kids and family, trust for generations. Exactly. Each generation is different according to the economy. That's a great one right there, Kelly. So that's something that I study is how each generation is actually a little bit different when it comes to money and wealth, how we think about it, how we create it. Each generation is definitely different, and the economy is not the same either. It's very different. Passed on to learning how to store and save money. Yeah, passing knowledge on. And so we'll talk about that one a little bit too, Tess, because that's a big one right now. Is the education part, the knowledge part of it. So here's what I want to think about. So let's kind of go into another kind of topic around generational wealth. So when we think about generational wealth, how is it actually lost? So now that we understand what we think generational wealth is, now let's kind of talk about how is generational wealth lost. Okay, so I'm gonna bring up my screen here, and we're gonna take some notes for people that are maybe not on the call but are watching the recording. But how is generational wealth lost? Okay, so use that chat box. How do you think it's lost? Now this kind of gets into an interesting point. Now what I mean by lost is, let's say that one generation has money, has wealth, but the next generation or the second generation beyond them doesn't have it anymore. How do they lose it? Okay, taxes. Yeah, actually that's a good one right there. Taxes. Okay, make this a little bit bigger. Dumb decisions. I like that one. Lack of knowledge. That's a good one right there. Not invested. Lack of education. Yep, lack of knowledge. Knowledge not being passed down. Absolutely. Not knowing how to grow wealth. Markets. Economy. Probably economy, right? Too much spending. Yep. And so I would say that's I guess squandering. You squander your money. No protection in place. I like Frenchie. Yeah, no protection in place. That's a good one right there. Didn't earn it. Yeah, did not earn it, and don't respect it. Like that's how I look at that. They don't respect the wealth, right? Because they didn't earn it, right? It's lost its value, inflation, that kind of stuff. And so when I think of like generational wealth, and I've studied wealthy families, and I've actually been into some masterminds where there are actually some billionaires in the group, and I've learned quite a bit from them. So how generational wealth is lost is a couple things. One is that the next generation doesn't have the knowledge. So, and that, by the way, that responsibility, it lies with the current generation. So like, let's look at our parents as an example. If they built wealth and built money, but didn't pass the knowledge of how they created it on to the next generation, then it's often squandered, it's wasted, it's not secured, that kind of stuff. So that's a big one right there. And additionally, one of the biggest things that I see when it comes to generational wealth and how it's lost is that it's not passed on correctly. So there's no vehicle to pass it on to safeguard the money, to safeguard the wealth. And so that's a big one. So like as an example, and if you look at like the Rockefellers versus the Vanderbilts, like there's two different families. Now the Vanderbilts, now by the way, the Vanderbilts that are alive are still very wealthy, but it's a fraction of what it should have been because the generation that created the wealth, they didn't pass it on correctly. And so it got dispersed. So think of it this way. Let's say you have, $10 million of wealth and you have, let's say, 5 children. Okay, and then when you pass on, you graduate, as we call it in the BYOB world, it gets dispersed. So each children gets $2 million. Okay, maybe they go buy a house, go buy some cars, spend the money. Then their kids only get maybe a couple $100,000, and the wealth at that point is gone. So it's just gone. It's not protected. It's just it's watered down. And that is a big thing that happens a lot. And I've seen it actually in my own family. I've seen the exact same thing happen where it's like there's a large amount, it gets dispersed, and then it gets watered down. So it's not worth as much as it was for that first generation. That's a big one right there. Additionally, one of the other things that I didn't see anybody that put this one in place or in the notes, but people they fight over it. People fight over wealth because money is very emotional for a lot of people, especially if you didn't earn it. And all of a sudden there's this big payday because somebody in your family passed away and everybody fights over it. And you can really look at like celebrities and wealthy people that when they pass on and they don't have anything in place to pass the wealth on strategically, all the families fighting over it. There's lawsuits, there's court orders. You can look at, I think another good example of that is Michael Jackson. So when he passed on, there was a lot of debt, but there's also a lot of assets, but there was no real plan on how those assets were to be passed on. And there was a lot of internal fighting. You see that all the time. I used to have a list of a lot of people where that happened, where it was destroyed because the family fought over it, and there were lawsuits in place, and it had to go through the court system. Another thing we didn't really talk about is probate. So when you pass on, you have an estate. How is that estate handled? Well, in my own family, I had some grandparents pass away, and the state, the local government, they got a hold of the estate and it went through probate. So there was all these costs associated with it. It was public knowledge, all that kind of stuff. And it was kind of really unfortunate how that all happened. But there was not a lot of assets though in that place. But yeah, Frenchie right there. Every attorney will tell you that they fight over it. Exactly. Yeah, they fight over it. Prince. That's what I was thinking of. Yeah, yeah, Prince. So there was another. There's a lot of people like that have a lot of wealth, but they don't have good advice, and it's just destroyed because they don't protect it. So these are a lot of things how generational wealth is lost. Okay. Michelle said there's a famous case where siblings fought over a kid's cereal statue. Okay, yeah, something like that. Yeah, that sounds something familiar like that. But you'll find a lot of cases like that, or a lot of case studies where generational wealth is completely lost because families fight over it, and it's unfortunate. And it lies with the generation that creates the wealth. By the way, that's who's responsible for that. It's not the next generation, right? Elvis Presley, great example. Yeah, I used to have like this poster, by the way, and I can't find it anymore, but it's a poster, and it had all of these famous people that had a significant amount of wealth, and then it had like a little description of what happened when they passed away. Elvis Presley was on that. One of the posters was about him, by the way. Yeah, so it's really unfortunate. So yeah, so just kind of keep that in mind when it comes to generational wealth, is that it oftentimes is lost. So even before you create the wealth, you've got to think about how are we passing this on? And even with infinite banking, which we're going to talk about here in a little bit, it's exactly the same thing. When it comes to infinite banking, which by the way is life insurance has a huge death benefit. It's tax-free and guaranteed, right? It's going to be passed on. How is it going to be passed on responsibly? Making sure that it lasts for that next generation and the generation after that and after that. And so we're going to talk about how we can do that. But generational wealth, legacy wealth, I mean, it's a very cool thing. It's nice to be able to do that. But once again, if you don't do it correctly, it can have the opposite effect. So instead of having a good outcome for the next generation, it can actually destroy them and ruin families. Okay? Tax strategies, wealth protection, asset protection, Michelle, absolutely. All of those things are very important. So the next thing I want to ask about is first off, now let's kind of talk about, well, how is generational wealth created? Because we're talking about money being passed on and how it's lost, but how do you actually create generational wealth in the first place? So what are some ways that generational wealth is created? Hard work. Yep. I mean, yeah, basically hard work. So like my parents, by the way, are a great example of hard work. My dad, he worked really hard. He had a job in the parks department for a local government, and then ended up becoming the city manager and just worked his butt off, to be honest. Worked really hard, and has a very solid retirement, built wealth, like that kind of stuff. But he had to work really hard for a lot of years. But yeah, he's a good example of that. Investing. So passive income. Yeah. So Andy, so passive income is a great, a great thing to have to create wealth, but how do you create the passive income? Business. So that's a big one right there. So businesses. So entrepreneurship, having your own business. And I call this, being your own boss. So when you are your own boss, you are your own business, you can actually create wealth. Now, if you guys have seen my presentation on infinite banking, I do this part where I talk about what are the three things that we want to control in life. Well, we want to control money, right? So how you build generational wealth is by controlling money. Controlling money, okay? The second thing that I talk about that you really want to control as well is your time. So being in control of your time, that's not really a generational wealth thing, by the way. It's just something that, for me personally, is a big thing when it comes to control. I want to control my money. I want to control my time. Now, the third thing is mindset. So, mindset to me is probably one of the biggest things when it comes to generational wealth. And we'll talk a bit more about this one here in a second. Saving. Yep, saving, hard work, and saving. Those are great ones right there. Business and investing. IBC. Yeah. So, of course, infinite banking is one of the it's probably one of the best ways I've seen to create generational wealth, by the way. But it's a different kind of way of doing it because, like when you have a business, when you control money, when you save, when you have hard work, you're experiencing the benefits of that. With infinite banking, you can benefit from it while you're alive, but the next generation is going to benefit even more than you will, usually in most cases with it, because it's because of how it works. Passive and leveraged income, absolutely. Life insurance policy versus, yep, we're going to be talking about that one here in just a moment. Real estate, actually, that's a great. I was hoping somebody would say real estate, so I saw that one. Real estate is one of the best ways to build generational wealth because it's a solid asset. But why real estate is so good for generational wealth is it's one of the three things, or one of the things that you need to survive, right? Food, clothing, and shelter. Shelter, right? Real estate is one of the things that's always going to be here. It's been around for thousands of years. It's not going anywhere, and we all interact with real estate every single day, whether we think about it or not. You go to the grocery store, that's real estate. You go to a restaurant, go to your job, you live in real estate. Real estate is all around us. It is one of the best ways to build wealth, especially generational wealth, and you can pass it on. Yeah. Let's see here. A business, yeah, business. So business is a good one. It's not for everybody. I mean, I think everybody should look at business or entrepreneurship, but once again, it's not for everybody to do that. But once you are an entrepreneur or you own your own business, you can control money a lot more. It can control time, which allows you to build wealth a lot easier. Life insurance, instant inheritance. Absolutely, Robert. That's a great one. Let's see here. What else do we got? Trust funds. Yes, trusts. So trusts are what we're going to be talking about here. Stocks. Yeah. So actually, Kareen said this. So stocks are actually a great way to build wealth. Obviously, you got to understand it though, but you got to actually understand how stocks work, and you got to do it correctly. But you can also lose a lot of money with those as well. Nobody said Bitcoin. I'm kind of surprised there because it's going crazy right now. But yeah, Bitcoin is something that I hear a lot of people talking about, but that's not something I do as well. Yep, controlling assets. Okay. So the one thing I want to kind of touch on here a little bit is the mindset side of things. Now, why mindset? So let's kind of talk about that one for a second. So when it comes to generational wealth, one of the biggest things that you have to overcome is the mindset side of it. Because when we go through life and we're going to school and we're earning money, we're not really taught how to build wealth or even how money truly works. In fact, if you go through the traditional educational system here in the US, we're taught to be employees. That's really where the whole educational system came from. Back in the Industrial Revolution, they created the educational system to create people that had just the barest minimum of education to be good employees. That's really what happened. And so that has not really changed all that much. So we're not really taught or educated on how to build generational wealth or how to create generational wealth. We have to be the instigators. Okay. We have to be the ones that start doing it. We have to change our mindset first. So it's for me. So I've taught mindset. I've ran my own masterminds, things like that. But mindset is probably the biggest one. And even for me today, I still have to overcome my own mindset, my own programming, I call it, my subconscious programming that was instilled in me when I was young around money, around wealth, around time, all that kind of stuff. And so it's a really challenging thing for a lot of people. Now here's the cool thing. Now, if you go study like wealthy families, what you'll find is that there is like one person or like a couple, like a parent and a husband wife that decided to change something. They wanted to change their life. They wanted to go into business. They did something. They're the ones that were the instigators of generational wealth. And so when I go look at my own family, like there is like I don't have generational wealth, but there's nobody that really had a lot of wealth though because nobody started that process. But when I go and study like other wealthy families, you'll find there is one person or a couple that were the instigators. Okay. And so the challenge is that, how do I say this? Is that like today, like you say, hey, I want to create generational wealth. It's hard for a lot of people to go and do that. The reason why I believe that it's hard, and I want to get your guys' opinion on this one. It's hard because we never experienced the benefits of generational wealth in our own lives. So it's hard for us to go and create generational wealth because we don't have that mindset. Nobody ahead of us was saying, oh, yeah, here's my wealth. I'm going to pass it on to you. And here's my knowledge about how I created it. That doesn't exist. So if that doesn't exist in our own lives, yet we want to create that generational wealth, we have to be the ones to start that process. And that can be very challenging for a lot of people. And in fact, so I don't know if any of you guys know who Kevin Harrington is. So he's a very wealthy individual. He was the original shark on the show Shark Tank. Okay, he was the original shark, and so he was in one of my masterminds I was a member of a couple years ago, and one of his business partners was named Mark Timms, and so I was talking to them about this whole thing, and this is what they said. They said yes. They said I didn't have that parent that passed the knowledge on to me, so I had to go create it myself. And yet Brian Harrington, which is Kevin Harrington's son, he had a different take on it. He said, I have generational wealth because his dad is Kevin, right? So he's already very wealthy. He goes, I didn't have to create the generational wealth because it already was there for me. But I was able to get the knowledge. So his dad really passed on the financial knowledge to his son Brian. And so Brian Harrington, he has a lot of knowledge about wealth. And so he's doing the exact same thing that his dad did, but he didn't have to be the instigator for it. Does that make sense? And it's easier for him. So he said, yeah, it's easier for me to keep the wealth and maintain it because I had the knowledge. I didn't have to go out and create it. So it's interesting. So Brian Harrington was telling me, he goes, yeah, so I'm using all of these strategies, financial vehicles, so that my kids are going to have it easy, right? So it's very easy for Brian Harrington to continue generational wealth because his dad passed it on. Okay. Now for Kevin Harrington, the guy that started it, it was a challenge. He had to go and create all of these things. He had to be that instigator, right? But Brian, not so much. It was easier for him to pass it on. Now for his kids, as long as he passes on the knowledge and some of the wealth, it's going to be even easier for them to maintain and grow the wealth. Okay. So if you ever hear the term the rich get richer, right? That's why right there. Because they have the knowledge and they have the resource, which is money. So if you have those two things already, it's easier to maintain generational wealth. That makes sense? Yeah, yeah. So Michelle said greed inside our government makes it difficult. Correct, right? And so yeah, you can look at politicians in the government for when it comes to generational wealth, but man, I think they're crooks. I don't care what side of the table you're on, they're all crooks. They all benefit. They're in it for power. Now, whether you believe in Trump or not, I mean, I don't think he's in it for as much as other people are when it comes to money because he already has it. But man, it's weird to when you study people like that come into power, they leave office richer than they were when they first started. Back when the U.S. was created, it was the opposite. You actually were poor after you went through government because you weren't working and you weren't paid very much. It's the opposite now, which is but that's a whole other topic, right? It's a whole other topic. Yeah, yeah, yeah. Task, absolutely right there. Yeah. So, and by the way, so I mean, if you want to talk about like strategies, how wealth is created, so we're taught to use IRAs, 401ks as retirement vehicles. But in reality, and this is kind of a side topic for a second here. The 401k was never meant to be a retirement vehicle. If you ever study what a 401k is, well, first off, it's IRS section 401-K, right? And so, like the question I always ask people is, do you believe the IRS has our best interest at heart? Do you believe they're the best stewards of our money? No, absolutely not. Yeah, Kristen said no. Everybody says no, right? No. But guess what? We are taught to put our money into a 401-K, which is their section, but we don't believe in the IRS. So why are we putting our money to a 401k? That makes no sense. But we're taught to do that. So even though we know intuitively the IRS is probably not the best, stewards of our own money, we are essentially handing over control of our money to them. Now, the 401k was never meant to be a retirement vehicle. In fact, when it was created back in the 80s, I believe, it was created as a way for highly paid CEOs and executives to hide their taxes or hide their bonuses from taxes. There's a book by a buddy of mine. His name's Andy Tanner. He's one of Robert Kiyosaki's advisors, and it's called 401 Chaos. It's 401 KOAS. So when this was created, the 401k, by the way, and it's kind of a side topic for a second here, but I think it's worth noting. That's what it was created for. And so Andy, he knew the guy who created the 401k, and he says it was never meant to be a retirement vehicle. But guess what? What happened? Well, we were programmed. We were actually subconsciously programmed that, hey, this is a good thing to do. Because what happened is employers before the 401k existed, how did you retire? Mainly through pensions. And who was responsible for the pension? Okay, exactly, Tess. So who's responsible for that? The employer. So who's at risk? The employer. The employer's at risk because they're taking your money, they're responsible for it, they invest it for you, and then they give you lifelong income after retirement age. Well, that's risky for them. So then what happened? Well, along came this 401-K, and employers said, hey, wait a second. If we use this and tell people, hey, we're going to fund this, we are actually off the hook. So what happened is the risk was transferred from the employer to the employee, because you're at risk. If the market goes down, or if the person that's managing your 401k loses it, who loses? You do. Who makes money no matter what? The IRS, Wall Street, right? They actually are the ones that actually make money even if you lose money. That is crazy, by the way. So the 401k, in my opinion, is one of the biggest scams that ever got sold to the American public. Now, that being said, does a 401k or an IRA, do they create generational wealth? No. Look at this list right here. There's not a 401k is not on there. I mean, yes, you could say hard work and saving money up into that is that, but no, it doesn't create generational wealth. In fact, it does the opposite, in my opinion, because when you go to retire off of a 401k, you're going to sell that asset, which is the stocks. You're going to liquidate it, which means your wealth is going to go down, and hopefully you die before it goes to zero. That's a weird thing to say, but that's what it is. And so I have talked to a lot of families and stuff, and I've had family members that have passed away that had 401ks and things like that, and they literally had pennies when they passed on. No generational wealth, nothing to pass on. It's kind of sad. And so some of you know my story. So I actually just moved recently. I'm in North Idaho. I was in Washington State. My father-in-law, he passed on the 1st of this month. Actually, the day that I packed up my kids and drove over to move was the day that he passed away. Okay. And he didn't have any type of retirement. Yeah, thanks, Michelle. Appreciate that. Yeah, we just had his memorial here a week and a half ago. Yeah, but he had this house. That's it. He didn't have anything. He had no savings, no 401ks, nothing like that. He had a pension, by the way. He had a pension, but once he passed away, the pension's gone, and we were left with there's some debt. There's a house that needs a lot of work, and that's it. And so he didn't create any generational wealth. And a pension, a 401k, IRA, those kind of things, they don't create that. Okay. So that's what we kind of want to start thinking about. When you look at your situation, what you're doing and what you're doing with your money today, and by the way, this is only if generational wealth or legacy wealth is important to you. Okay. For some people, it's not important. And that's fine, right? If you don't have, that next generation, then this does not really apply. But when you start looking at what you're doing with your money today, how is it setting up that next generation so they don't have to struggle? Maybe they have, they have easier access to money, maybe they have assets, maybe they have cash flow, but how are you setting them up, right? Okay. All right. So the next thing we can talk about really quickly here is how do you create generational wealth, right? We talked about it right here. Now, how is generational wealth secured? So this is kind of the third topic we can talk about here, and then we'll kind of we'll look at some infinite banking strategies and how that can really create generational wealth. But how is it secured? Okay. So Andy said a trust, living trust. Yeah, a lot of people are going to say trusts. Now we have some partners we work with that do trust, by the way. So if you guys are interested in a trust, just let us know. We can connect you with those individuals. But a trust is a great way to secure generational wealth because here's the thing. As we talked about in the first couple of slides, if that money is just passed on without any kind of restraint, without any kind of controls, it can be destroyed, it can be lost, it can be fought over, it can be dispersed, all that kind of stuff. So one of the best ways to make sure that your wealth is passed on is a trust. Now, why a trust? Well, one, a trust, by the way, is not really for asset protection. It's more about probate, irrevocable trust. Exactly, right there. But a trust can take your estate, which can include your wealth, your assets, all that kind of stuff, and then you're going to have your wishes already built inside of the trust so that when you graduate, or we call it graduate, but when you pass on, the trust will then take your wealth and handle it based upon your predetermined wishes. Okay. So when you think about trust fund babies, we've heard that term before. That's what that is, by the way. A trust fund baby is a person that has wealth, but it's controlled inside of a trust. So the trust has been built so that when that person passes on, the next generation does not get free reign or just complete control of the wealth, right? It doesn't happen that way. It's actually going to say, hey, you're going to get X number of dollars, for this number of years, etc. That kind of stuff. So the other thing I call them is I call it family trust. And that's what I call those things. It's called the family trust. But it's essentially where you have all of your assets inside there, and then you have like an executor or a team. We call them a committee that manages the trust after you're gone based upon your wishes. And that trust, by the way, can be multi-generational. And so I've studied some wealthy families and they'll have these trusts that are very, very involved. And typically when you're doing the family trust, it's like $10 million or higher net worth. And they'll have a team of people like attorneys that are in charge of it after the fact. And then this is what you got to do though. And this is where I learned this from, it was Kevin Day. So Kevin Day, he is Robert Kiyosaki. If you know him, he's his asset protection attorney. And so he talked to me about this. He said that the thing you have to do though is you have to actually pass on the knowledge. If you don't pass on the knowledge, a trust is great, but eventually the wealth will be destroyed. You have to pass on knowledge. If you don't pass on knowledge to that next generation, eventually, even with a trust in place, that wealth will be lost. So knowledge is one of the biggest things. And so I've worked with a lot of high income families on the infinite banking side of things, and I always ask them this one question. Who is the primary person in the next generation that's going to be the leader? That's going to be the family leader that's going to take your place. Because let's say his name is Bob. So Bob is the patriarch of the family. He's the head of it, right? So we think of like that pyramid. At the very top, you have the patriarch, and you got all the generations down below that. You got the kids, grandkids, great grandkids. Okay, but you have to have that patriarch, that leader. Okay, now the next generation has to have that same person. And so I always ask that, who is that person? And then how are you passing on your knowledge to them? Making sure that they understand, hey, this is how we're going to create generational wealth. And I have unfortunately come across a lot of families where they don't have that person. And so the one person is creating the wealth, but they're not passing knowledge on. And I always tell them you have to pass it on. It's not just the money, it's also the knowledge. That makes sense? Yeah, marriage transfer for sure. Yep. But yeah, so a trust is one of the best ways. By the way, a trust also prevents probate, or it makes sure that your estate is also private. So one of the biggest destroyers of wealth also is that when your estate goes public, meaning you pass on and you have no trust, it goes into probate. That's public knowledge, by the way. And when that happens, the public can come after your wealth too. So you've probably heard about this where all of a sudden there's like this random family member, like a family member that comes out of the woodwork when you pass on, and they say, oh, so and so said I could have $1 million, and they take it to court. Now you got to go through the court system. There's money, all that kind of stuff. So when you have a trust, it makes sure that your estate is private. Okay. Additionally, if you have a will can be contested. Okay. It can go through the court system. It can be contested, all that kind of stuff. But if you build your will inside of a trust, it negates that. Okay. And by the way, a video will is better than a written will, by the way. So if you guys have never done that before, a written will is great. But what you want to do is do a video of you reading the will and clarifying what it means to you, because if you do that, man, it makes it really solid. Actually, I never knew that, but Kevin did actually told me about that. He goes, yeah, that's one of the best ways to do it. And then you also have to have, you also want to have witnesses and things like that that are not family members. Yeah, so that's one thing I had to learn too. So so I created a will for my father-in-law before he passed away, and we had to have somebody notarize it, and then had to have a witness. But the witness cannot be a family member. Like that was a big thing right there. I didn't know that, but an attorney, yeah, that's why I go get attorneys for this kind of stuff. But they said, yeah, you don't want it to be a family member. It has to be somebody else. And typically it should be somebody that does not know your family. It's just a third party person. They listen to the will, they read it, they sign it. There you go. So we actually did that for him. So it worked out really well. Um, so how else can generational wealth be secured? Yeah. Yeah, Frenchie, I don't know. I mean, can you trust a video with AI? I mean, I would say yes, but I mean, every day it's getting kind of crazier and crazier, to be honest. But yeah, I mean, it's going to be very interesting down the road. But the one of the best ways to do it is to have it be on a tape, a recorder, not on a digital one, but on a VHS kind of thing like that, because those can't be edited. At least as far as I know, they can't be. But that's one way to do it, is to do it on something like that. But yeah. But back when I learned about this, the AI stuff and all these video things weren't around. So that's how we did it. So one of the other ways the generational wealth is secured is assets, is having physical assets like real estate. So because real estate, you can pass it on really easily, whereas like stocks and things like that are a bit different, but assets are a great way to pass it on. Additionally, of course, one of the other ways to secure generational wealth is with infinite banking. Okay. So, and we're going to talk a bit more in depth about infinite banking and how that can create generational wealth, and how wealthy families use infinite banking. Okay. And that's why when you hear the term like, oh, why does that wealthy family keep getting wealthier? Why does the next generation have more money? Well, by the way, wealthy families, politicians, those kinds of individuals, they use infinite banking to create generational wealth. It's why they get wealthier and wealthier. So they combine infinite banking with a family trust. When you combine those two things, oh my gosh, it is amazing. It is amazing what you can do. So yeah. All right. So any comments, any thoughts on generational wealth? I'm going to pull up some stuff here in just a second. We're going to go through infinite banking as far as how that works for generational wealth. Because I actually just did this for a family here recently. It was really cool what it did for them. So okay, so let's go ahead and let's go and bring this up really quick. Yes, good. So someone just mentioned this, like the Kardashians. Yep, they created generational wealth because what they did is he was very wealthy, but they created behind the scenes. One, they had life insurance, but two, they have trusts in place, family banking and family trusts that secure the wealth. So yes, they can access it, that kind of stuff, but they can't destroy it as easily as if it was just given to them, without any restraints, for sure. All right. Okay. So now let's kind of talk through infinite banking. So now a lot of you know what infinite banking is. So infinite banking is cash value life insurance. And so when we set these up for our clients, I see a lot of people on here that are clients of ours, or I've worked with you. When we set these things up, what we're doing is we're creating the cash value. Now that is a living benefit. Okay, the cash value inside life insurance is a living benefit that allows you to borrow against your cash value for whatever you want in life, whether it's buying cars, creating cash flowing assets like real estate, paying off debt, all those things, right? It's a living benefit. But the other thing that infinite banking does, because it is life insurance, is that it has a death benefit. Okay, a death benefit. Now that death benefit is tax-free and is guaranteed. Okay, so that is generational wealth day one. Now, when you go look at all these other things we talked about right here, how's it created? Most of these things don't create generational wealth day one. Real estate, stocks, a business, saving money. They don't create generational wealth day one. Infinite banking is the opposite. It does create generational wealth day one. So what I'm going to look at right now really quickly is a policy on a newborn. So this is really where when you start to think about generational wealth, it starts with you. Okay. So let me kind of clarify what I mean by that. So generational wealth, if you don't have it right now, who's going to create that wealth for that next generation? It's you. Okay. It starts with you. And you have to, one, focus on the mindset, but two, you've got to take action. You've got to do something. And sometimes that can be very hard because you're not going to experience the benefits potentially. The next generation is going to experience it, but you will be around. So it's a weird way to think about it that, hey, I'm going to go do this. Maybe it's infinite banking. I know that it's going to benefit the next generation, create that generational wealth. I know that I'm not going to be around to see it. It's kind of weird, right? So a lot of people don't take action to create generational wealth because of that reason right there. Because they're like, what's the reason? What's the purpose? Oh yeah, my kids will be fine, but I'm not going to go do all this work for them to benefit off of me, off of my death, right? But once again, that's a mindset thing right there. Because and this is where I learned from some wealthy families, the generation, like my generation, they were very wealthy. They experienced the benefit from the previous generation. So of course, they're going to go take action to create that wealth for the next generation, make sure they get it as well, because they experience the benefits themselves. So yes, you've got to take action. You've got to do something different if you want different results for that generation.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you've felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
So infinite banking is one of the best ways to do that. So what we're going to do is we're going to look at this. I'm going to make this a little bigger. So this is let me go up here real quick. Okay, so this is a young kid. That's what I named him. This is a male, age 0. So I said they were born in October of 2024. Okay, now on this policy, we're going to put in $200 per month for their entire life. Now you can stop if you want to, but $200, that's not a big deal, right? So we're going to put in $200 into the specially designed infinite banking design policy. So this is specially designed whole life policy with this is with One America, by the way. Okay. Yeah. So Tess said, yes, you wish you'd done this sooner, right? There you go. And Cody, I'll answer that question right now. So what if you have no family but important friend? Yeah, you can pass it on to them. You can pass it on to that next generation. Doesn't have to be your relatives or your family. You can pass it on to their kids, their grandkids, that kind of stuff. Okay. And Frenchie, yeah. So yes, when it comes to these kinds of policies, there are minimums and maximums. Absolutely. And so when it comes to juveniles, which is a kid, the amount you can put in is based upon the death benefits or the income of the guardian. So think of the parents. So as an example, with like One America, if the parent, so with this kid right here, if the parents have like, let's say, $2 million of life insurance death benefit, they can get $1 million. I believe it's $1 million of death benefit on their kids. If they have $1 million of death benefit, they can get $500,000 of death benefit on their kids. Okay. Now, and that's different between companies, by the way. So like Lafayette, theirs is you can get, let's say if you're a parent and you have $500,000 of death benefit, you can get up to $500,000 of death benefit on your kids. If you have $1 million, it's up to $1 million. So they match it up to $1 million. It's the same amount you can get. Now, why do I do One America versus Lafayette? The reason why I did this illustration for One America instead of Lafayette is because with One America, you can fund the entire premium of $200 for their entire life. Okay, so that's going to grow that policy a lot. Whereas Lafayette, you're going to be cut off at year like 20, 25. You'll be cut off as to how much you can put in. So that's kind of that's why I did it with this one. So I like One America for juvenile policies that are just straight premiums. Now let's kind of look at the numbers on this one. So once again, so we're putting in $200 per month from day one. Now you can do it on a juvenile when they're born, right? When they're born. So it's like within the first week, I think. Yeah, Chad. So great question. So he asked a question. He says, "Does Lafayette allow the same for a child based on a grandparent?" So no, it's not based upon the grandparent. It's based upon the guardian. So that's usually the parents. If the grandparent is the guardian, it's based upon the grandparent then. But Lafayette does have grandparent policies for juveniles. And so a grandparent can get a policy on a juvenile. I think it's up to $150,000 of death benefit, I think, with no qualifications on the guardians. So if the parents have no coverage, the grandparent can still get a policy on the kid, the grandkid, for up to 150,000, I think it is. So, yeah. Okay. So on this one, let's look at the numbers here real quick. So on this one, we're going to put in $200 per month. That's $2,400 per year. So you're going to see that right here, $2,400 per year. Now, when it comes to the illustrations, we look at the non-guaranteed side, not the guaranteed side. So if you're clients of ours, you probably heard me talk about this before. We look at the non-guaranteed, which is the dividend side, because historically, they've always paid the non-guaranteed side. They've never paid the guaranteed side because these companies, mutual insurance companies, they've been profitable every single year they've been in existence. So One America has been around for 149 years. They have been profitable or paid dividends every single year for 149 years. So think like the Great Depression, World War I, World War II, COVID, all that kind of stuff. They've always paid this side of it. Now, on this one, what you're going to see here, see how there's no cash value? So this is what's called a traditional life insurance policy. It's not infinite banking focused, by the way. And we're going to build one that is infinite banking focused here in a second, but it's not infinite banking focused. Now, what you're going to see though, is even if it's a traditional whole life insurance policy, not infinite banking, it still is going to grow and have cash value. So look at this. So day one in this policy, you put in $200 day one, you have $547,000 of death benefit already day one. Now that's not really generational wealth because they're a newborn, but it's their day one, right? Okay. Now, if you continue down this one, even though it's not an infinite banking policy, because it is whole life insurance, it still starts to grow cash value. You'll see it right here, right there. Total net cash value. So when this person is 30 years old, they have $93,000 of cash value inside this policy. Now let's do the math and say how much have they put inside of it. 2,400 times 30. They have put in $72,000 into this policy over 30 years. The cash value, which is what they can borrow out, is $93,000, and the death benefit is $682,000. So if this person, this young kid, at 30 years old, gets hit by that proverbial bus, right? He's put in 72,000, but his beneficiary is going to get $682,000. So do the math on that. 682 divided by 72 is 9.4 times your money. So the next generation is going to get 9.4 times what he has put into this policy. Okay. Now let's go down the road and let's just go look at age 75. Okay. Let's say that young kid has an unfortunate event and has a heart attack at 75 years old. So at that point, he has put in $180,000 into this policy. Okay, so let's do the math. This is generational wealth here, which is really kind of cool. So he's put in $180,000. The cash value is $981. So this person can be using that money to go create other assets that cash flow, like real estate, fund his own business, whatever. Private lending, private money club, wink, wink, right there, right? But get this, the death benefit is $1.4 million. So if you do the math on this, that's 8 times what he's put into this thing. So imagine that you take a policy like this, you fund it for your kid, and they keep funding it. The next generation is going to get 8 times what has been put into this thing. So when you understand what I just said, you'll understand that why do wealthy families do this? Why do they do infinite banking? Because they can do what I just said. They can create generational wealth guaranteed tax-free. I don't know of any other vehicle out there that does this. So this is why infinite banking or whole life insurance is why the wealthy do this, because they can create that generational wealth right there. Now keep in mind, I showed you a policy that was not even infinite banking focused. I just wanted to show you what it can do, okay? That is very cool right there. So think about that. Yeah, David said these are amazing numbers. They are absolutely astounding. So when I was talking to like Kevin Harrington, and he's a billionaire, at least he was at one point in time, I'm not sure he still is or not, and his partner, I was doing a presentation in front of this large group of very wealthy individuals, and they came up to me and said, hey, what you just said about generational wealth is 100% true. because we're doing it. I was like, holy crap. It was pretty cool. But to have like a billionaire come up and say, hey, man, you're right. Generational wealth, you're right. This is what we do. And so Mark Tim, he told me, he goes, yeah, I have policies on my kids. When they were born, I fund the policies. I use them. So he told me that he was buying like real estate, like warehouses with the kid policies. And then when his kids get older, like when they get married or they turn 21 or graduate college, he's going to gift them the policies. So the kid is going to become the owners of their own policies, continue funding them and then using them. And then Mark's grandkids will be the beneficiaries later on down the road. So he's creating generational wealth multiple layers deep. So he's funding it. He's wealthy in his own right. He's funding policies on his kids, which will then get passed on. So his policy will pass on to his kids. His kids' policy will pass on to his grandkids. So you start to see the waterfall effect. So this is how wealthy families secure their wealth because they put wealth into policies, knowing that it's guaranteed tax-free to be passed on at some point down the road. Okay. And by the way, Chad, yes, he said this is without any PUAs. Correct. This is without any PUAs. Now, the dividends are purchasing PUAs. Okay. So that's how it's growing. This is without even doing infinite banking. Okay. So what I'm gonna do right now, we are gonna go look at an infinite banking policy with a juvenile, and then you're gonna see how this thing really starts to take off. Now I've got to log in really quick, and I'm going to build a policy, the same exact one, by the way. But now we're gonna turn on the infinite banking features, and you're going to see how this thing can really grow. It's going to be pretty amazing. And I've done this presentation before, and it's why I wanted to share it with you guys here on Wealth Wednesday, because Wealth Wednesday. And by the way, who here on this call who is doing juvenile policies or has policies on their kids? Is anybody doing this already? Yep. There's someone that says yes. Yep, doing it on my kids. Yes. Nathan's doing it. Yep. Yeah. So what happens is when you do these on yourself, and then you realize how powerful it is. We always say, I wish I had learned about this 20 years ago. Okay. Well, guess what? Start it on your kids, because they won't have to say the same thing. Yeah, David, on your 16-year-old, Christian, yeah, I'm wanting this on my kids. Yeah, absolutely. And the policies on kids are really simple, by the way. Yeah, so Robert said, yeah, you had cancer. Yeah, if you had cancer, you can't get a policy. You can always get them on your kids. And it still functions the same way as infinite banking. You just can't do some of the more aggressive features. But I'm going to show you something you can do on a juvenile policy that really just makes it it's on fire. Okay, so let me go ahead and run this one, and we will look at what an infinite banking policy on the same person looks like down the road. Okay, now let's go look at this policy. This is going to be pretty cool. Jason, does it go with the lesser insured parent amount if both parents are insured? It depends. It depends. So it depends on the company. So with One America, I think it's the lesser, and then with Lafayette, you can choose. I believe it is. I believe that's the way it is. Okay, but good question though. Good question. So same thing. So young kid, $200 per month, and now we're doing infinite banking. Now you'll see what happened is the death benefit went down a little bit. Okay, it went down a little bit because now we're having more of the premium going to PUAs. Okay, which is called paid up additions. That's what grows the cash value in an infinite banking structured policy. So you're going to see right here, you're going to have an amount going in there. Now it's not very much because I didn't maximize this one, but here's the thing. So now when you go look at, go all the way back up, these are very long illustrations because of the age. Okay. So now what you're going to see is going to have some cash value. Now, once again, by the way, I'm being very conservative, by the way, with these. I'm being very conservative. We can get very aggressive on the PUA portion of this. I'm not doing that because I just want to be very conservative with how these are structured. But now you're going to see there's cash value going in day one. So now let's go down to year 30. So you see it's going to be a bit higher than the other one. It's a bit higher. But now let's go to age 75. Okay, come down here. So on age 75, we put in the same amount, $180,000. Now the cash value is $985, and the death benefit is $1.4 million. So it's gone up a bit more. So, but here's the thing. So you can get very aggressive with these. So that's how this can work. So you guys starting to see the picture here, how the things can really grow and create generational wealth. Once again, guaranteed, tax-free. I don't know of any other vehicle that does this, by the way. Of all the things we listed before that can create generational wealth, this is the only one that has that, that's guaranteed. Okay. So now what we're going to do, we're going to have a little bit of fun with this thing. Let's go ahead and put in what's called a lump sum or a dump in. So when you do infinite banking policies, you have the option of putting in a larger amount up front. So we're going to put in, let's just do $5,000. upfront and see if this will let us do that. Now, when you do these lump sums or these dump ins, what you're going to do is you're going to jumpstart the policy because the majority of that $5,000 goes to cash value. But more importantly, is you're earning dividends on that $5,000 day one. Now, what you're going to see is a policy that has a larger amount going in. So you'll see it right here in the header. It says additional premium at issue. Now, let's look at the numbers on this one. Once again, this is just all we did was just added $5,000 day one. That's the only thing we changed. Now, let's see how that changes the numbers. Okay. Now what you're going to see is year one, you have $5,000 or $5,090 of cash value. Okay. So once again, that $5,000 jumped up the cash value, which is what you can borrow against. Now, let's go down to age 75 and see what changed. Okay. Now that number is $1.08 million. It went up by over $100,000. So we added $5,000, but the amount of cash value at age 75 went up by over $100,000. So if you understand what I just said, we turned $5,000 into $100,000. Now, granted, it takes time. That's the compounding effect. But additionally, the death benefit also went up by quite a bit. So if you understand what I just said, you'll understand why wealthy families do infinite banking and why they fund these things. Now, by the way, this is just $200 per month. Imagine if you teach this to your kids and they start multiple policies down the road. Or let's say that you start a second or a third one on your kids as they get older. So let's say you do one at age 10, at age 18. Imagine the amount of generational wealth you're going to create. You're going to take $1 and turn it into 10 times that value. But more importantly, with infinite banking, you can borrow against the cash value throughout the entire life of that person, or they can borrow out of that policy and create more wealth while not interrupting the growth of this policy. Because let's say this person, let's go to age 50, there's $339,000 inside this. Let's say they borrow $300,000 and go do something over here. Maybe they go and buy a multi-unit complex, an apartment building, something like that. The policy still grows exactly the same. And yet they have that money working for them in a second spot, which can be that apartment building. So now you start to understand generational wealth. You can multiply your money many, many, many different times or many ways because of this one concept. So when I look at like a business, when you look at, oh gosh, what was the other thing? Some of the other things we mentioned inside there, real estate, stocks, that kind of stuff. Get this, you can do this and those at the same time. It's not one or the other, it's both at the same time, okay? That is really incredible. So this is what the wealthy are doing, by the way. And so if you go study some very successful people, oftentimes behind the scenes, this is one of the vehicles they have in place. And by the way, I mean, I've been a part of some very high level masterminds, and yes, they're doing this. In fact, a buddy of mine, his name is Mark Evans, an acquaintance of mine. I've known him for quite a few years. He's very successful, very wealthy. I knew about infinite banking. I never talked to him about this, but then one day in one of his masterminds, he says, "Oh yeah, I'm putting $100,000 a month into infinite banking." I was just like, "Whoa! I didn't even know that. I didn't even know he was doing it." But once again, they are. What's his name? That gentleman. Oh gosh, I always forget his name. Joe Biden. Yeah, yeah, that guy. That guy. He's actually has 4 of these policies. Senator John McCain, when he passed away, had 6 of these, 6 policies. Now, you say, well, Brian, who else has these? Well, we don't know because they're private. These are private contracts. So unless somebody says, oh, I've got infinite banking, or I've got cash value life insurance, they don't have to disclose it, and it's not public knowledge. So like we believe a lot of people out there, especially politicians, are doing this concept because it privatizes their wealth and protects it and guarantees it. So those are all really good things, by the way, to have in place. Private, protected, etc. Yep. Yep. Yeah, Jim Harbaugh. Yeah, so yeah, Jim Harbaugh. Yeah, I use that in my presentation. Tess, you've seen that. It's in the news that he was paid his bonuses when he was a coach through cash value life insurance. Now, why would they do that? Why would they do that? Okay. Well, guess who's the beneficiaries of his policies? The college. So the college literally funded his retirement or his bonuses with life insurance, right? So they funded the policy, cash value. He can borrow the cash value to use it for whatever he wants. But when he passes away, the college is going to get reimbursed times 10. I mean, that's crazy, right? That's insane, right? So yeah, exactly. All right, so Cody, yes, what's the minimum? So I mean, typically 10 times your age, your age is what we recommend. But let's say for a kid, I mean, I've seen people doing them for like $50 a month, something like that. You can do them really small, by the way, but typically, I mean, the $200, $100 range is kind of where we see a lot of the juvenile policies do it. Yeah. Walter said, I did it before, plus it's way better in the US. Yeah, yeah, yeah. That's the one thing about infinite banking. It's in the US and Canada only, so it is limited. And you know, of course, you do have to qualify if you want it on yourself. But juveniles, as long as they don't have any kind of medical history, there's no medical exams, by the way. It's just they qualify right off the bat. So we can typically do them. I mean, within a few days, sometimes they're approved. Yeah. Chris, you said for my own IBC policy, I've contributed 48,000 in premiums. The death benefit is already $200,000 four times. Excellent, excellent wealth building tool. Absolutely right there. So that's exactly what we're talking about. You can put in that money and know that it's going to be turned into a larger amount for that next generation. Once again, generational legacy wealth is what we're talking about here today. This is the best way I have ever seen to do it because it's not about just doing this. It's about doing this and other things. Okay. So like, let's say you want to, hey, I want to take $50,000, $10,000, and I want to create an asset for my kids. I want to go buy real estate. I want to go do this. Well, do both. You can do this and the real estate because you can leverage the cash value, borrow out, put it in the real estate. Now you've got two things that can create wealth for the next generation. Chad said, is it recommended or not to have the beneficiary a trust to keep financial plans on track for generations to come? I would say yes, absolutely. Yeah, absolutely. So the last thing I'll kind of mention is when it comes to generational wealth and infinite banking is that a trust can be the owner of the policy and the beneficiary. So once again, if you have a policy on a child, or even on you, by the way, the beneficiary can be a trust. And so when someone passes on that death benefit, you know, let's say this person passes on at age 50, that $1.02 million, which is tax-free, guaranteed, it doesn't go to the family first, it goes to the trust first. Then the trust will fulfill the wishes, make sure that that wealth is, you know, is stabilized, and maybe it's going to be passed on, maybe in certain amounts. One thing, this is what I did. Okay, so on another family, we did this. So when the patriarch passes away, the trust will become the beneficiary of the policies, right? And they're going to take the money and create new policies on the next generation. So his trust is going to purchase more policies on that next generation, with the beneficiaries being the third generation down. So he's going to explode the wealth for every generation based upon the trust's, you know, structure. So yeah, yeah, very cool. But yeah, so definitely I do recommend having a trust and having but the challenge is also, by the way, is you have to talk to an attorney or a trust attorney that understands infinite banking. Yeah, because that's a big one right there. You want to make sure you understand that. Cody said, if you die with the money you borrowed, what happens? So if let's say this person right here, young kid, passes away at age 50, he has 1.021 million in death benefit and a $339,000 cash value in the policy. Let's say there's a $100,000 outstanding loan. So what happens is the death benefit is paid out less that loan. So that's called the collateral for the loan is the death benefit, by the way. So that's the way that we talk about it. But yeah, so it just comes out of the death benefit. So and that, by the way, that's why the insurance companies do this, or why they allow us to borrow against them, is because they have collateral, which is the death benefit, which they have to pay out no matter what. Okay. Chad says, I have a very large policy with a 600K dump in an 80K year policy that already has over $500,000 in available cash. By year 4, it will make cash on cash positive flow on available funds for loans. That's amazing. That's the reason for asking about a trust. So, but yeah, I mean, I definitely do recommend. And by the way, you can move the IBC policy into the trust at any point in time. So you don't have to do it at day one, by the way. So a lot of people say, well, Brian, I don't have a trust. Should I get a trust first, then do the policy? Doesn't really matter. You can do the policy first and then transfer the ownership into the trust and the beneficiary into the trust down the road. Yeah. But yeah, so yeah, Chad, so yeah, you can. And so we have people that do that for us, for our clients, that will set up the trusts because they know infinite banking very well. And then somebody asked about my personal call link. Let me go ahead and bring that up real quick. So if anybody here wants to chat with me at some point, I'm going to put my personal call link here into the chat real quick. So if you guys want to chat with me personally or have any questions after this, feel free to reach out to me. And then there's my email address as well. So it's brian@chrisnaugle.com is my email address. But yeah, so I've done this structure for quite a few families, and what actually was it was 3 generations. So the last one I just did, it was the grandparent or grandfather. He has a policy. He has one on his son and daughter-in-law, and then the 5 grandkids, and we did them all at the exact same time. Yeah, it was really kind of cool. So he had, some money that came in. He didn't want to just put it into like real estate or something like that. He wanted to make sure that it secured generational wealth for 3 generations. So that's what we did. So when you think about it, so he's insured. His beneficiary is his son and daughter-in-law. They have policies. Their beneficiaries are their kids. Okay. Their kids have policies. The beneficiaries are the parents, but will then eventually be their kids' kids. So that's 4 generations right there. Now, what we're also doing for him is that after all the policies are set up, he has a trust. So the grandfather has a trust. All of the policies, there's 8 of them, all of the policies will be owned by the trust. So we'll change ownership like 3 months down the road. And then we're going to change the beneficiaries of all of the policies to the trust as well. And then he's setting up this entire financial plan for 4 generations deep. And so that's what I did for him. And it was really cool to see the whole thing come into fruition. It was amazing. Yeah. So he's working with one of our advisors on the trust side of it. And then I did the policies for him. But yeah, Jason said here, if you have one child who has a policy and then have another child, you have to get a policy for them up to the value of the first child before more can be added to the first, because equal amounts. Yes, correct. And it's give or take a certain percentage, by the way. I think it's like within 20%. So not always, but yeah. So like the way that they look at it is if you're doing like policies on kids, the insurance companies want you to have the death benefits be equal for the kids within, and not exactly, by the way, it's within a different, it's like 20%, 30%, usually. But yeah, they want them to be, they want you to treat your kids all equal because you can't play favorites with kids, by the way. Now, I have done it though, by the way, Jason, where a kid had a policy, they had another kid, and they went and got another policy on that kid, and it was a completely different amount, by the way, because when you think about it, like the one child was a newborn, the other one was 15 years old. So it's not really fair to like put in the same premiums but have different, but the death benefits are different. And so if we tried to make the death benefit the same, the premiums would be completely different, completely different. So on that one, they actually allowed us to do the same premiums on both of them, but the death benefits were completely different. So it just kind of depends. Yeah. Mark, yes, I am. Yeah. So Mark asked if I'm licensed to operate nationwide. Yes, I am. Yeah. 49 states, by the way. There's one state that I'm not licensed in. I can't remember which one it is. It's like one of maybe like North Dakota, something like that, because there's might be like 10 people that live there. But yeah. Lucy, it is allowed. It is allowed. You can do policies on grandkids without the parents having one. So you can do it. So here's a couple different ways to get around that, by the way. So one way is if the parents have term insurance through their employer. So a lot of times, if you're a W-2 employee, working for a large company, you'll have what's called group coverage. So it's like a term policy. If you have that, that can qualify you to get the kids to get a policy, even though it's with the employer. So you can do it that way. The other way is what's called grandparent policies with Lafayette. You can get up to a certain amount of death benefit on the grandkid without the parents being covered. So there are ways to not really get around it, but there are ways to get coverage on the grandkids. Yeah, so just kind of keep that in mind. Yeah, yeah, that's actually kind of something that I've done. I actually just recently did that, by the way. So yeah. And then Christian said, how would I be able to get policies on my parents? Well, you can get policies on your parents. They would have to go through the application process and the approval process, and it depends upon their age. So if there's a certain age where it doesn't really make sense to do a policy on adults, like it's usually right around early to mid 70s. Yeah. So yeah, so if they're 68 and 70, yes, they can still get policies. They're not as efficient, But yes, you can get them. Now, it's going to be based upon their income or their net worth. So oftentimes, if they're retired and they don't have a lot of income, it's hard to get a policy that makes sense. So I've done this before with a lot of adults that are at 70s, even in their 80s, and they have money, but they can't get a policy on themselves, but they want to do something with that money. And so that's where we do the generational wealth policies on the next generation or the grandkids. And so that's a way for them to pass that money on. Virginia asked, I have grandchildren that are in their 20s. If I wanted policies, how does that work? So same thing. So if they're in their 20s and they're not juveniles anymore, so keep in mind juveniles versus 18 or older. 18 or older, they're not considered an adult, so it's not a juvenile policy. So if they're in their 20s, the policy would be based upon their life value, so their income, that kind of stuff. But then you can be the owner of the policy. So I'm doing this with somebody I think it was today. So the grandparent is going to be the owner of the policy on their adult grandkid, and so they're going to fund it. Now, the thing is though is that the policy structure is based upon the grandkids, not on the adult, not the grandparent. Okay. So just kind of keep that in mind. But yeah, so I'm doing that on I think a 24-year-old male right now. The grandfather is in the 70s. He can't really get a policy because his cash flow doesn't allow him to get one on himself. But he wants to take the majority of the income and put it on in a policy. So we're going to do it on his 24-year-old grandson, who qualifies, by the way. Yep. So yeah. All right, guys. So any other questions you guys got on this so far? So I mean, hopefully this was knowledgeable. Hopefully this gave you some insight on generational wealth, how infinite banking can play into that. Because a lot of people don't even think about policies on their kids. Yeah. But yeah. So in fact I have three young kids. So they're 14. My daughter's 14, going on angry. My son, he's going to be 12 here in December, and then my youngest is 9, and so we're going to be getting policies on them here probably in January, February, something like that. We're going to be getting policies on them. Now, this is a question that does come up quite a bit. So what if you have a child that has medications or is on medications, things like that? Yes, you've got to disclose that kind of stuff, and it can have an impact on it. So yeah, so my son, by the way, he's autistic. So if you have a child who is autistic, they have to be over the age of, I think it's 6 or 7 to get a policy. So if they're diagnosed like at age 3 or 4, you can't get a policy. You have to wait until they're, I think it's 6 or 7, and then the ability to get a policy depends upon their level of autism. So my son is level, I don't know what it's called, but 1 or 3, I don't remember which one it is, but it's high functioning. So very high functioning. And so because of that, he can get a policy. So that was something I had to go and actually do my own research on. But yeah, so he can get a policy, but they have to wait until of a certain age, and then they have to be that high functioning level. Yeah, Asperger's level. Yep. Yeah. So he's in school right now. I mean, and he goes to school. He's talks, all that kind of stuff. But he definitely is autistic. So yeah, so just gotta kind of keep that in mind. And yeah, I'll put up my call link again too for anybody that wants to grab a time just to chat about any of this kind of stuff or infinite banking. Oh yes, somebody asked another question here. If you have 3 kids, will they allow you to get a policy on one and not the others? The answer is usually no, they won't, because they're going to ask you why. Why are you insuring one kid and not the other ones? And so usually if you have 3 kids, it's all or nothing. In most cases, by the way, in most cases. So I could get policies on my 2 daughters and not my son. I can do that, right? But in most cases they're gonna ask how many kids are in the household or how many dependents are there and what's their coverage. They're gonna ask that, and you have to disclose that during the application process. So, and the reason why you got to disclose it is because if you don't disclose it and they find out, they can actually they can cancel the policy in the first 2 years. So you got to be very careful about that. Yeah, maybe I don't like the other kids. Exactly. Is it the same for grandkids? I believe so, yes. And I'm talking under the age of 18, by the way, under the age of 18. But yes, I believe for grandkids, I believe it is the same. I'd have to ask. I think it's all or none, all or none. Yeah, but it does depend too where the kids are at. So this is where you can when we talk to the underwriters, we actually can explain the situation, why we're doing something that maybe they wouldn't approve in the first place. So let's say you have 4 grandkids, and let's say one of them lives with the father and the other 3 live with the mother. because and like the father has custody of that one, etc. Then in that case, it would be different. You wouldn't have to get them on all four. It would be either on the one or on the other three because they're in different households. So there are different ways to look at it. But yeah. And can my daughter 23 begin her whole life policy for her future family? Absolutely. So that's, I mean, right there, and this is a great question, Harry. He said, can my daughter who's 23 begin her whole life policy for her future family? Absolutely, absolutely. In fact, if I had known about infinite banking when I was 23 years old and got my first job out of college, I would never have done a 401k. I would have done infinite banking. And then as my life, progressed, I would change the beneficiary to my spouse, eventually change it to my adult kids if I wanted to, etc. So yes, absolutely. I have lots of clients that are in their 20s and they're saying, I don't have a family yet, but I plan on having one at some point down the road. I want to get this going today. So yes, absolutely. My grandkids already robbing the generational wealth. Yeah, so yeah, there you go. Yeah, Tess, everybody always says, I wish I could have done this in my 20s. Absolutely. So, like, that's the weird thing. So for me, I say the same thing. I wish I'd done it in my 20s. Well, I can't because I'm not 20 anymore. But guess what I can do? I can make sure that my kids are set up so that when they're 23, they already have this in place. So they can use this for buying their first car, for maybe paying for college, down payment on their first house, all that kind of stuff. Yeah, 18 years old, great. I actually have a client. Uh, he called me. He was 17 years old. 17 years old, and then he was turning 18, and so that he got approved. I can't know how we did it, but when he turned 18, bam, policy was in place. Yeah, it's kind of cool. And then so someone said, once you have IBC to maybe start an IUL. Well, the question would be why? Why would you do an IUL? I mean, we don't do IULs, and in fact, because we're part of the Nelson Nash Institute, we're infinite banking practitioners. If you are a person that does IULs, you cannot be a part of the Nelson Nash Institute. They won't even touch you if you do IUL. So yeah, we don't really do those. Yeah. But there are different vehicles. I mean, yes, they do have the same features as infinite banking policies, but they're a different structure. We have a lot of videos on YouTube that go through those. But yeah, me too, Tess. I'm taking it here. I think probably after the 1st of December, I'm going to take it, or I might maybe it's next week. I can't remember, but I'm going to do the same thing. Yeah. What's the minimum per month with a 32-year-old? 320 per month. Yeah. So Teresa, so if you're 32 years old, 320 per month is the minimum recommended. You can do less, but that's what we recommend. That's where the policy becomes more efficient. Yeah, we'll celebrate for sure. Chris said, I bought a traditional life insurance policy when I was 22. If I'd known about IBC then, I would have done IBC instead. Well, Chris, so even if you have a traditional whole life policy, it'll still grow cash value as long as it's with a mutual insurance company, by the way, and is a whole life policy. But you can always, if the policy is not very efficient, you can do what's called a 1035 exchange and move the cash value from that policy into a new infinite banking policy without any repercussions or any penalties. So just kind of keep that in mind, but you can always move them over. Dan said here, I'm 65 years old. My son is 42 years. Can I start a policy for him? And what would be my payment per month? So we use the term deposits. So if he's 42 years old, the minimum recommended is $420 per month for him. So that would be the minimum recommended. But you can, and then the maximum is going to be based upon his gross revenue or gross income. Okay, it's around anywhere from 20 to 30% of that is the maximum per year divided by 12. Leon, the video for this is going to be on our YouTube channel. So if you go to YouTube and just type in Chris Naugle and then subscribe to his YouTube channel, you'll see these recordings on there. So Cody, so IBC practitioners exam, where can I study for that? So this is the Nelson Nash Institute. It's infinitebanking.org. And then if you want, you can go to the practitioners program right here. You'll see it right there. Now, it does have a fee to it. It's I think it's $2,000, I think, to get into it. And you get I don't have mine in front of me right now, but you'll get a workbook, pretty thick one, by the way. And then there's a whole list of videos you watch, and then there's an exam that you'll take eventually, and then you can get certified as an IBC practitioner by the Infinite Banking organization. So yeah, so that's what it is right there. It's a very, very good program though too. It's very knowledgeable. Let's see, what was that question right there? Are there lump sum IBC policies, and how much can I put in? Age 55 and 56. So it depends, Jenny. So it depends. So when you say lump sum, If you're thinking like a single pay premium policy, those don't really exist. But you can put in a large amount, like let's say 10, 20, something like that. You can put that in up front. That's called a dump in or a lump sum. We can build those as well for multiple years. But there's going to be a premium deposit that's a monthly, quarterly, or annual. And then on top of that, you can do what's called a lump sum or dump in. And so the minimum recommended for those ages per month is 550 or 560 per month. And then if you were doing like that as the minimum, you could put in up to like a $50,000 lump sum on top of that if you wanted to, which builds the cash value very quickly. And you can borrow within, the first, 2 to 3 weeks usually. That's the infinitebanking.org. And then Christian said, do I need to be a practitioner to join the team? Actually, that is one of our requirements. Yes. Is that you have to be in the process of getting that license. It's just something that we believe in. But if you want to talk about it, just send me an email. We can chat about that. But yeah, typically we want all of our people like me to be a licensed person and a practitioner of infinite banking. All right. Well, we're almost at the 90-minute mark. Any last minute questions? Any thoughts? But not to have a policy. So one of the things we do require is that if you are going to want to be part of our team and do that kind of stuff, is one, be a practitioner of infinite banking. So be using it in your life if you can. Right? Some people don't qualify, and then obviously be licensed, and then at some point make sure you are a practitioner through the Nelson Nash Institute. Yeah. How does the dump in payment able to be used after 35 days and then repaid? Okay, so Leon, so the dump in is called it's a paid up addition, PUA. Okay, so a PUA, 90% of that goes to cash value. So if you put in a $50,000 dump in, that's 45,000 to cash value, and that's going to be there within the first typically 30 days, but even quicker usually 2 to 3 weeks of opening the policy and funding it. And then when you borrow against it, that's a loan. So that's called a policy loan. The loan is one that you control. So there's no minimum, no maximum payments on that. It's up to you how you repay it. Now we help you with that though, and how to structure that. Correct, Cody. Yeah, if you want a policy, you don't need a license, but you have to have a licensed person create the policy. So that's what I do. So I build policies. So Frenchie said, what's the difference between the whole life and an IUL? It's night and day, by the way, night and day. So an IUL is a derivative of a whole life policy, by the way. So whole life has been around for over 100 years. IULs have been around since I think the 80s. An IUL performance is tied to the markets, okay? In most cases, it's indexed, right? Indexed universal life. A whole life is tied to the profitability of the insurance company, okay? That's called dividends. Dividends, and there's guarantees, by the way, in whole life policies, but I want to be tied to the profitability of the company because every single mutual insurance company has been profitable since they've existed. They've never not been profitable. IULs tied to the markets, I don't want to be a part of that system. So that's just my personal kind of thoughts on it, but that's one of the bigger differences. But additionally, infinite banking concept is based upon whole life policies, not IULs, because at the core of infinite banking, one of our missions, or Nelson Nash's mission, is to remove our money from the monetary system that is currently corrupt. That's just my kind of term for it. But think of corporate America, Wall Street, the markets, all that kind of stuff, and gain back control of our money. So one of the best ways to gain back control is to not give it to that system. So with infinite banking, with the whole life policy, you're in control of your money because it's tied to the mutual insurance company, which you are a owner of it because you have a policy. That's what mutual means. You're a fractional owner of the insurance company. That's why you get the dividends. And it said, make that less than 2 months, first meeting to policy issued. Yeah. So good point. So when you start the application process for infinite banking, there's an application and underwriting process that can be anywhere from a couple of weeks to 8 weeks. It depends on the person, that kind of stuff. But yeah, once the policy is issued and funded, we say that you can access the cash value within 30 days, but it's usually a bit quicker than that. Yeah. Exactly, Tess. There's no license that you have to get a policy. You just have to work with a infinite banking practitioner or someone that is licensed and understands how to set up the policies. That's what we do, by the way. Stocks, yeah, correct. Yep. Yeah, someone asked for my thing again. Yep. I'll put my email address in here one more time. And then see here, Leon said, what would have to hypothetically happen for IBC system to not work? I mean, so I've had this question many times. So it doesn't really matter. If the monetary system changed from dollars to gold or to Bitcoin, the insurance company would just operate in that currency. That's it. They would change. I mean, insurance has been around for thousands of years, and they'll just operate in whatever fashion everybody else does. So if that does change, then they'll change as well. I mean, that's the simplest answer. But yeah. Now, what would happen? So here's the thing. So for infinite banking to not work, or like for like this system to not be functioning anymore, I think that you're going to want to be more focused on guns and ammo, to be honest, because if infinite banking, like these companies are not working, or if they go down, something has happened, in my opinion, something has happened in the world that is catastrophic. Because once again, these companies have been around for hundreds of years, and they've operated just fine. They've never gone under. There's never been a mutual insurance company that has gone under. It's never happened. So if that does happen, man, something catastrophic has occurred. And I don't think you're going to be too worried about your life insurance policy at that point in time. Now, that all being said, though, this is another good point I'll bring up. So during COVID, a lot of people were freaking out because they were saying, "Oh my gosh, what if a third of the population dies? What's going to happen to my life insurance policy that has a couple $100,000 of cash value inside of it?" Well, guess what? One America, the company we were just looking at, the illustrations, they did a stress test during COVID. A stress test is it's where they say, hey, if every policyholder dies, what will happen to One America? They'd be just fine. So once again, let me repeat that. If every policyholder died in One America, the company would continue operating just fine. So think about that for a second. Think about a bank. A bank can't say the same thing. Now, One America has about like $95 billion of assets under management. That's actually assets, not like paper money, like like billionaires who, oh, I'm worth 150 billion. That's on paper, right? These companies have assets. So yeah, it's crazy how they function and how they work. But yeah, that's why a lot of people, wealthy people, by the way, put a lot of money into infinite banking policies because they feel it is one of the safest places to store your wealth, to store your money, versus a bank, versus this, the Wall Street, that kind of stuff. Because these life insurance companies have been around longer than the IRS. Kind of crazy, right? Yeah, yeah. Michelle said that's a great point right there. To think, all the insurance companies, they know that all their clients at some point are going to pass away, so they will pay out those death benefits. They've never defaulted on that before. So good point right there. Yeah, yeah, yeah. It's a job for life. Absolutely, absolutely. Yep. IRS, the new kid on the block. 1913, by the way, 1913. That's when the Federal Reserve and the IRS came into existence, and that is when the government, in my opinion, started to strip away control of the money from the public. That's what had, and it took about 120 some years for that to happen. Obviously, in the 70s when Nixon took us off the gold standard, that really stripped away the control of money and gave it to the government, so they can control money. But that's a whole other discussion, whole other presentation right there I can get into. But all right, guys, we've been on here for 90 minutes. Any last minute questions? Any thoughts? Any comments, questions? All right, guys. Well, I'm going to get ready for Ask Me Anything here in a couple hours. If you guys want to jump on, obviously go to Chris's YouTube channel and subscribe there. And we live stream the Ask Me Anything on there. Any questions on infinite banking or anything on anything, by the way, and you guys want to ask, go there and we'll be on with our team and answering questions. So appreciate all the questions, appreciate all the interaction, and then I look forward to speaking to some of you. I think I saw some emails come through and some calls scheduled already, so look forward to that. But take care, have a great rest of your week, and stay safe, everybody. Oh, one last question, Deborah. Can you transfer money from a 401k to IBC? No, you cannot. Not straight over, because it's a qualified plan controlled by the IRS. Infinite banking is private, so they are not compatible. So to get money from a 401k into infinite banking, you typically have to cash it out. So yeah, IT sucked and just did that. Yep, there you go. All right, guys, take care. We'll talk soon.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.